America will surrender to the inflating monster. Martin North, John Adams, in the interest of the people. Hello, John. We're back in the studio again.
Hi, Martin. How are you going today?
Yeah, pretty good. And you've got an announcement before we get started?
Yes. So I've got a special announcement. So over the next few weeks, I'm going to be back on the road doing a number of seminars across Australia. So we have one coming up on the 13th of July in Adelaide, and we have one coming up on the 20th of July in Newcastle. So we hope to do a few more across the country. I was doing a few seminars last year, but unfortunately with COVID and the lockdown, we had to sort of cancel some of our plans. So we're going to put a couple of links to how people can get tickets. And if people would like to come along and hear me for a couple of hours go into a lot of technical economic stuff and political insights, feel free to come along.
Great, thanks, John. Well, we'll put the links below, and as you say, if anybody wants to sign up, they know what to do.
Yeah.
Always worth 2 hours of their time, I would suggest. But hey, particularly now, right, and particularly because, well, we're at a turning point, aren't we? Potentially.
Yes. So over the last probably 6 weeks to 2 months, we've been talking about how we're going to get to this real crunch point of this decision between inflation versus saving the economy from recession and a potential financial crisis, and what will the central banks do. And so in some of the last shows, we've talked about how the Bank of Japan, the ECB, and the Bank of England have all pretty much surrendered to inflation already because their response to rising inflation to date has been basically piss poor, if I could use that term. So now, obviously, one of the critical aspects now as we move forward is what the Americans are going to do. And so we're going to talk about how America is going to surrender probably. It will be hard to say. I mean, I think you've said 3 months. I think it's going to be less than 3 months. They're going to surrender to this inflation monster because the choices that they have are quite stark. And we have some new information about the United States that we're going to cover today.
Yeah, and I guess it's worth highlighting again this dilemma between trying to keep inflation down and dealing with the issue of a failing economy. A failing economy may be financial markets down, property markets down, etc., etc. So that's the dilemma that the central banks are facing. And it's interesting that even recently, Andrew Bailey in the UK, who looks after the Bank of England, was worrying about inflation, saying it's going to get worse and it's going to get quicker. But they're not doing much. So there's a real words and figures differ around the place. And I think with the latest data from the Fed, we're very interested to see whether they change their tune.
Yes. Martin, one of the hardest things, I think, for our audience, but the market at large is finding it hard to understand is how to get a read on the economy when these politicians and central bank officials say things that sound good on the surface, but then when events unfold, what the events show is that these politicians and central bankers, they were telling a pack of lies. So I've got a bit of a collage. So if we can just put slide 2 on the screen, just to give our audience a bit of a flavour as to the journey over the last almost 2 years in terms of Jerome Powell. And so he has consistently got everything wrong. And so we can go back to August of 2020 when they were just rolling out the extraordinary stimulus. And he said that they would be targeting inflation above 2%. So inflation would be in control. And obviously at that point, inflation was below 2%, and he was concerned about that. So he wanted to say, well, we need to get inflation above 2% so we can try to generate growth again. And then when we get to April of last year, inflation was starting to surge, and you and I did a few shows about stagflation, both in 2020, but also in early 2021, we talked about accelerated stagflation under the Biden administration. And then when that inflation was coming through, they said that was transitory inflation. Then by December of last year, they had to basically admit that it wasn't transitory, it was more permanent. And then as they've been raising rates since March, they've been shooting down any risk in terms of the US going into recession. And so on the 16th of June, this is being reported by the Financial Review. Basically, the US, which was done 2 weeks ago, you've got Jerome Powell saying shooting down any US recession predictions. And only a couple of days ago did Powell, and this is again reported by Bloomberg, Powell says Fed can avert recession. But as we will show in the next couple of minutes, the big data out of the US this week is the US economy is technically in recession right now.
Yeah, and of course it's one of those weird things where they say one thing, but you have to read between the lines really to see what's going on. I guess the other point, John, is that they often rely on lagged data as well, right? So they're sort of steering without any compass.
Well, I mean, thing is that we talked at length in terms of our last show. In the case of the RBA, what data are they looking at? Is it lagged? Is it out of date? Is it what sort of forward-looking information do they have? Yep. And we showed, I think, quite convincingly that the RBA at least is pretty much flying blind. But you would have thought that there's a lot more outfits in the United States that are producing detailed statistical series both in the government sector but also in the private sector. So you would have thought that there'd be a lot more information for the US Federal Reserve to have a better feel for how the US economy is traveling. But all right, Martin. If we can go to slide 3. So the really important aspect, Martin, is just for our audience to understand is in the first quarter of calendar year 2022, the US economy shrank by 1.6%. And now we have the Atlanta Fed. So the US Federal Reserve has several branches across the United States. So the Atlanta Fed branch, they track GDP and they come up with a forecast. And so the latest forecast that came out on the 1st of July was that GDP for the second quarter will come in at 2.1%. Now we'll have to wait a couple of weeks for the official figure to come out, but obviously they're forecasting that the US economy is shrinking and is shrinking at a faster rate compared to the first quarter. And what's really driving the dynamics in the second quarter is weak consumption growth and basically what they call real gross private domestic investment has shrunk, an estimated shrinking by 15.2%. So domestic investment is going through the floor under the Biden administration, and that's a continuing feature right throughout the last 6 months. And as they raise interest rates in particular, the US consumer is spending less, particularly when you combine that in terms of the inflation. So when you think about your own data set in the Australian context of in terms of cost of living, coupled with these rising interest rates, that's why your mortgage stress just hit an all-time high in terms of your data in terms of last week. So we're seeing the same sort of dynamics in America, and so when we see the official statistic come out, probably in the next 2 weeks, we will have the official confirmation that the US economy is already in recession. But the fact that the US Federal Reserve, its own people, its own models, are now saying that the second quarter is shrinking at a faster rate, that is a very significant aspect. That's a very significant fact. And so we now go into July, Martin, and the US Federal Reserve will next meet on the 26th and 27th of July. And we have a prospect of the US Federal Reserve potentially raising interest rates in a recession, and that doesn't happen all the time.
And just 2 quick observations. The model that we're talking about here from the Atlanta Fed is purely a mechanistic mathematical model based on all the input data that's coming all the time, right? So it's a real-time update. So it's one of the most forward-looking of all the indicators that's out there, right? It doesn't have any sort of fuzzy sentiment stuff. It's just purely mechanical. But in the past, it's actually been quite accurate in terms of predicting where things are going. So I think we should have a reasonable degree of confidence that their model will turn out to be reasonably appropriate. And the second point is they've already sort of signaled, significant rate hikes, and the markets are still signaling an expectation of higher rate hikes. So the policy dilemma is real, isn't it?
Yes. I mean, so we've got annualized inflation at 8.6. Now, on the 13th of July, the next CPI number for the US will come out, which will probably show that inflation has gone up again. So we have the US economy shrinking at a faster rate. We're going to see in the next 2 weeks inflation continuing to go higher, with no certain point in time as to when inflation will peak. And you're going to have this big policy dilemma as to what does the Fed do on the 26th and 27th on the 26th and 27th of July. Now, one of the really interesting aspects of this, Martin, is that this situation that we now see ourselves in is very contrary to Keynesian economics. So what Keynesian economics and standard macroeconomic management requires is that policymakers do things in a counter-cyclical way. So when things are booming, you tend to tighten fiscal and monetary policy to slow down the economy, and when the economy is slowing or in recession, you tend to use monetary and fiscal policy to be expansionary, so you can help the economy grow again. I mean, that's what Keynes's book and the General Theory in 1936 was all about, and that was obviously written in the whole context of in terms of the Great Depression, particularly of what was happening in the UK, Western Europe, but also in terms of the United States. And so, if we can put slide 4 on the screen, so here's an article from CNBC where they quote a global chief economist from UniCredit. And he says, quote, "Can you really hike interest rates into a recession even if inflation is high? That would be highly unusual." So that hasn't happened for a long time. But what we're going to discuss today is that it has happened in the past, and that was in 1974. And I think what happened in 1974 will give our audience some insights as to what happened in the past, but also what may happen in the next 4 to 8 weeks.
Yeah, I guess, John, the point I'd make is that clearly what they're going to say is, well, it's the conflict in Ukraine, it's the oil price. You know, they can come up with lots of different excuses as to why it's different this time, but actually is it? And as we'll see, the 74 example is a really interesting example because, well, history followed, didn't it?
Yes. So if we can just set up our audience. So if we put slide 5 on the screen, Martin. So what happened from 72 to 74 was we had the first OPEC oil shock. And that was when in terms of OPEC, which is effectively a cartel, they basically decided to restrict supply so that price would go up. And so inflation in the US went from 3.27 in 1972 to annualized 11.05 all the way up to 1974. And so if we can move on to slide 6, Martin. In response to this rising inflation, the US Federal Reserve decided to tighten monetary policy, and that was from February 1972 to October 1973. But then they decided to loosen policy because they thought the economy was, that the economy was potentially going into recession. And the interesting thing is that by 1974, the economy did go into recession in late 1973, early 1974, and that has been and that can be confirmed on slide 7. So this graph comes from the World Bank, and so the U.S. economy shrank in 1974 by about 0.5%. So basically, we have from 72 to 74. Tightening rates responding to an oil price shock, which is around supply, that had a contracting impact on the economy. They thought they were tightening too much. That's why from October 73 to February 1974, they decided to loosen. But as you get into February 1974, you have the same sort of dilemma as in the US economy is in recession, but at the same time, you have high inflation. And because inflation at that point, they weren't sure that inflation had peaked. And so they said to themselves, well, what do we do in that type of situation? And so what they decided to do was they decided to hike interest rates while they were in recession. So if we can just put slide 8 on the screen, what we can see is that from February 1974 to July 1974, the US Federal Reserve raised rates from 9% to 13%. And then by July, they had confirmation that inflation was starting to come down. And then they decided to loosen monetary policy all the way down to 4.65% by December of 1976, which was around 29 months. And that ultra loosening campaign then set up the explosion in interest rate, explosion in inflation going into the late 1970s.
Yeah, and I was around at the time, so being rather elderly, I can remember it. I can remember the dramatic situation with the oil price rising very strongly, interest rates going up, unemployment started to rise quite quickly in the UK, of course I was, and they were stuck. They were really caught as to what to try and do. And what was interesting was that effectively the rate of interest was higher than the inflation rate. So it was actually a real positive interest rate.
One question for you, Martin, is that so we had two big inflation problems in the 1970s. We had the one around 1974, but we also had the one around 1979, 1980, and obviously in the context of the UK, the out of control inflation, but the industrial strikes led to the election of Margaret Thatcher in 1979. So I mean, obviously the inflation was worse in the late 70s compared to the mid 70s. But I mean, your recollection. I mean, do you remember the mid 70s inflation, or is your memory really casting back to the late 70s?
Well, both. I can remember both quite clearly. And what was interesting there was that industrial relations were pretty shaky right the way through the 70s from the way things were done. They tried to control wage growth, so they had very strong controls on how much wages could actually rise to try and control it. So that was one of the levers that really didn't work that well. They also increased consumption taxes to try and actually calm momentum. I mean, they did a bunch of stuff. None of it really worked. And we actually ended up with 3-day weeks. We had massive numbers of strikes. We had power being turned off and power rationed. It was a pretty frightful turn of affairs. And actually, when Thatcher came in right at the end of the 70s, she sort of took a new road, and people said, well, at least perhaps now we can get some semblance of order, because people felt really most of the 70s was completely disordered.
One of the interesting things, Martin, that just comes to mind when you're saying that is that you're talking about power being rationed. Well, we have that now here in Australia. Now, not due to inflation per se, but because of climate policy, but also in terms of the global market around oil and gas.
Yeah, well, then it was because there were strikes, and basically all the power stations were picketed, and they couldn't get the coal into the power stations. Which meant that they had to ration the power. So they literally had 3-day weeks for quite a long period of time. And that was the same time as oil prices were also very high too. It was a pretty much disastrous state of affairs, actually.
So the power plants powered by coal were reduced capacity because of industrial action, whereas because of climate change, we've just shut them down anyway. But the other thing in terms of strikes, now obviously we have the issue of in terms of Australia, in terms of cost of living, with rising interest rates, and it's very interesting. Now we've had the Fair Work Commission decision recently, but also we've had, we've had some rolling strikes here in New South Wales with the train workers last week, and I think the teachers are coming up very soon. So this issue of high inflation, wanting wages to catch up, and now we're seeing industrial action to say, well, we want higher wages so that the wages can keep pace with inflation. And then you've got the RBA chair, so the RBA governor, only in the last fortnight saying that households need to temper their wage demands.
Yeah, and again, that was very much what's happening in the UK back in the 70s. I can remember quite clearly that then governor of the Bank of England making precisely the same point. Well, if you actually want to make big wage claims, that will just be inflationary, and that will just stoke inflation even higher, which means I've got to mess with interest rates even more. Same arguments, no more effective than probably they'll be this time, by the way.
Yes. So there have been a couple of videos only in the last couple of days where some economists are trying to say that the circumstances now are vastly different compared to the 1970s, but I think that there's a lot of commonality, and so I could see this a couple of years ago. That's why I started sort of doing the shows with you back in 2020 around stagflation, because all the hallmarks it all looked very similar, and so when we start to think of, well, how will this play out here in 2022? I think there's a couple of really critical factors that we need to consider in terms of why I think they're going to surrender to inflation. So the first one is we have no confirmation as to when inflation will peak. So they were saying only some time ago that inflation had peaked. In terms of some market economists, and obviously in the last month or so, when inflation came out higher, that shocked the markets, because that just showed that inflation has not peaked yet. And so we've got 8.6 for annualized coming into May, and for the June number, which is coming out on 13th of July, inflation is going to be higher, and we don't know exactly when inflation will peak. The other point is that so if inflation at the moment in the US is 8.6, and the federal funds rate is 1.75, to get the interest rate above official inflation is a mammoth task. So if inflation is going to come out high in the next 2 weeks, you need an interest rate of 10, 11, 12%. Yep. According to the official number, we know that the way they measure inflation in 2022 is vastly different to how they measured it in 1974. So some Americans say that real inflation is potentially 15 to 20% already. And so, you've got even the US Federal Reserve saying we're going to potentially raise rates to 3%, 3.5% in short order. Even if they do that, which I don't think they'll do, that's nowhere near getting the official interest rate above their recorded inflation rate.
No, absolutely. I think it's going to be really tough. And one other thing, I was just thinking about the 70s, John. There was also, of course, the exchange rate problem, certainly in the UK. They had all of these battles with exchange rates and all sorts of things, and they messed around there, and the ERM and out of the... It created huge financial waves, not just internally in the country, but in terms of its trade position with the rest of the world. And I think we should probably have a bit of a think, not now necessarily, but ahead, as to how this all plays out with regard to the exchange rate. And particularly, of course, the Aussie dollar is quite weak at the moment, and could potentially go weaker if this goes a particular way, particularly if the US continues to lift their rates very strongly, which will presumably strengthen the US dollar.
Yes. Now, the one other big difference, Martin, is how much debt America's in. So if we can put slide 9 on the screen. So I was able to find this through a bit of a internet search, but basically an economic outfit in the US have combined public and private sector debt and compared it to GDP. And so around 1974, total debt in the US economy to GDP was at around 150%. And so this graph goes to the third quarter of last year, which is 372%. And obviously in 2022, no doubt that ratio is probably higher than where it was in terms of last year. But basically, we have more than a doubling of debt to GDP, not just public sector, but the entire debt load. And so that's why when you aggressively raise rates, even from these low levels, the impact on the US economy in terms of investment, in terms of households, in terms of the corporate bonds, etc. Their ability to handle these high interest rates when they are so leveraged up. Yep. I mean, it is so limited. So the question then becomes is, if they continue to raise rates into a recession, which we have now confirmation of, the impact of that could be quite disastrous in terms of. So if anyone suspects soft landing is now completely off the table. It's either going to be a major, hard, deep recession, probably on top of that with a financial crisis, because these capital markets have so much debt, and so it is not just the US government sector, which is the federal government, state and local government in the US, which is they're drowning in debt. Obviously, a lot of these, in terms of the corporate junk bond market and some of the other ways that hedge funds raise money, they are so in debt that even a moderate raising of rates. We're seeing the crypto market fall apart already. And so this contagion could quickly spread right throughout the US economy, and they could have a serious problem on their hands. And so that's why I suspect, whereas in 1974 they raised rates over 5 months, and they got interest rates above inflation, and they were able to tame inflation for a few years before it became a big problem it became a big problem in the late 70s. I don't think they have the policy bandwidth to really get on top of the problem because of how much debt the US economy is in. And so that's why I think we're going to start to see some adjustments in their language to say, well, and to be honest, we've already started to see some of that already. Some of the governors who sit on the FOMC have said, well, we may not have to raise rates as much as what we were predicting before. And also some said, well, we potentially could be cutting rates in 2023. And so this has not been Powell, but these are some of the other governors who sit around Powell. They've already started to signal that we're going to fight inflation, but it may not be as serious as what the chairman has been saying. But now that the U.S. economy is in recession, Powell in the next 4 weeks, as they get to July 20 or the 26th of July, he'll have to finally admit the US economy is in recession, because only last week he was saying, well, we can avoid recession. Well, I mean, that's completely out the window. And then he'll have to admit that they can't seriously fight inflation because the cost to employment, but also financial stability. And remember, only in the last few months did he say, we will fight inflation subject to financial conditions. Well, those financial conditions are going to get a lot worse, a lot worse quite quickly, and he'll have to admit that for the sake of society at whole, they can't allow the financial markets to fall apart.
And it's worth just noting, John, that the bond rates actually came back last week, right? So the 10-year was knocking on a very high number, and now it's come back quite substantially, which suggests that maybe even the markets are beginning to wonder whether, in fact, they will take the rates as high as they were thinking earlier on. So we are in the middle of a really big dilemma here, right, for the central banks. And the question is, do they really get it, or are they going to continue to lift rates until they break something? Be interesting to see in the next couple of weeks.
Well, I mean, the question is, do they really get it? I mean, what we know is they've been lying for consistently. I mean, like for the last 2 years. Yep. They've been lying in this country. They've been lying in terms of the US. And so, all we really know is that they have a tough policy choice. And funny enough, in 1974, the US Federal Reserve chairman was a guy called Arthur Burns. And I was just reading as I was researching the show. Around this time, he had a meeting with Richard Nixon, who was the president at the time, and Richard Nixon said, give me inflation because I can't bear unemployment, because he thought the cost of unemployment was going to be too high. And obviously, one of the really interesting dilemmas in the US context as we head into this next round of decision making is we have a US midterm election coming up in November, and there'll be a real question as to, do we fight inflation, or do we potentially push not only do we push the economy into recession, do we really drive unemployment a lot higher, and what is the bigger political cost? So there's a big, again, I mean, a lot of people like to think about this in terms of economics, but a lot of this comes down to political decisions, and I think we'll be seeing the US Federal Reserve joining the Bank of England, the ECB, and the Bank of Japan very soon, and surrender to inflation. Yeah,
well, it is more a political decision actually than an economic one, I think, at the best of times, and even more so now. So as you say, we'll be watching the space and seeing where it goes, and very interesting and insightful discussion, John. Thank you very much.
Thank you.
Martin North, John Adams, in the interest of the people. We'll see you next time.